everyone doing? Everything good? Alright. So we're continuing to go division by division of a large international bank. This is how things are organized in most of the most of the banks, period. And we're just gonna go over the different products and the different issues that arise in these different products and why clients of banks want them and why banks supply them. And I think you're going to find a few interesting thoughts here. Any questions about the previous lecture? Or about the homework? Or anything about the exam that's coming up in your very near future? I see lots of smiles, people looking forward, people having parties to celebrate this in advance and afterwards. Very good. I'm glad that you all are excited about the exam. Okay, so corporate finance, corporate banking. The segments that banks usually service are just regular corporate clients, multinationals. Think of Novartis, think of Roche. Okay, they have businesses all over the world, but they're based here. They're serviced by at least one bank. Small and medium-sized enterprises, SMEs. Okay, SMEs is an acronym that repeats itself. Construction and real estate. Okay, someone's got to finance the construction of all these buildings that you're seeing around you. Okay, and guess who's financing them? The big institutions that have all the sources of finance. That's the banks. Because everyone else kind of doesn't really have the money. There's others in the economy that have money. Actually, there's the banks that have most of the sources of financing. After the banks, there's the central banks, but the central banks are quite limited in what they're financing. You have the sovereign wealth funds, okay? The sovereign wealth funds, the biggest one being the Norwegian sovereign wealth fund. They invest in pretty much everything that they can invest in. You have the pension plans and the insurance companies, and you have the university endowments, and you have the rich people. They're called ultra high net worth individual. They give them an acronym, but just rich people. And that's pretty much the large groups that finance things in this world. Okay, going back to corporate finance, there's also the segment of commodity trade finance. Okay, all these goods that you guys are consuming in your cars, oil and wood and anything you can dream of, it's got to be produced, it's got to be shipped, it's got to be purchased, it's got to be processed, and it's got to be financed at different stages, because it's not always that the capitalist has the knowledge how to chuck wood. Okay, how much wood would a woodchuck chuck if a woodchuck could chuck wood? No answer, no bonus. I'm sorry, you all failed. So again, there's the capitalist, and they allocate the capital, and there could be someone that knows how to produce oil, but doesn't have all of the capital that is required, or has excess capacity, and this thing needs to be produced, this thing needs to be shipped, and this requires capital. Basically everything requires capital. Every business activity is either consuming capital or is valued as capital. Okay, it can trade. So that's why I love this profession, because it's the ultimate profession. Maybe you make your money by being a professor or being I don't know, a high-tech person. You have big exits. You scam some people out of their money by issuing a cryptocurrency. I don't know how you make your money, but eventually you'll have your capital, and then what you're gonna do? You're gonna become a financier, because that's what you do with money. It's the default profession that is at the base of all other professions. That's why it's a pleasure if you really like it. Products, okay? So companies need bank accounts, of course. No business gets ever transacted without a bank account. So in various currencies, you can, if you're a company, you can get, or individual, you can get a bank account from your bank in various currencies. The predominant ones are the dollar, euro, pound. Okay? Dollar, euro, pound. These are the three biggest ones that people use. Debit and credit cards we've discussed. Time deposits we are going to discuss a little bit more now. There's something called offshore or third-party deposits, also called fiduciary deposits. It can be that you have a banking relationship with a bank here in Switzerland. That's your one banking relationship. They know you, you know them, you go to them for everything, all of your banking needs. They might tell you, or you may find out that it's tax advantageous for you to have your cash deposits offshore. There used to be some legitimate loopholes like this. I think they're closed by now, but there could be other, there is the diversification of counterparty risk. It may be that you want to diversify your cash deposits through several banks. Anyways, that would be a fiduciary deposit. It means that you deposit the money with a bank, but then the bank deposits it with another bank. And it's offshore, it's off balance sheet with respect to your bank's balance sheet. You can read about it, it's not really critical or important. Sweeping. Someone got a few patents for sweeping, as if it's sweeping. It's in America, there's several patents outstanding for this concept of sweeping. So let's say you're a big corporate and you have many bank accounts for different purposes, okay? If you're a big company, then you may have significantly more than one bank account. And you have a little bit of cash in each one of them. And then the bank came up with this brilliant product. They actually got there's a patent outstanding with this. And I don't know how enforceable it is, but anyways, then they take whatever cash you have in your various accounts at the end of the day, and they sweep it into one time deposit or one overnight deposit. Okay, so it's a different legal agreement between you and the bank that says it's not a demand deposit, it's a demand deposit, and then at the end of the day, whatever balances there are is swept into a time deposit with 1 day duration, and then you get a bit more interest. But you need to sign extra legal work because it's a different legal agreement when it has one night maturity than whether it's strictly on demand. It's good for the bank, it's good for you. You get a bit more interest because it's a little bit more profitable for the bank, because the bank now can lend it out overnight maybe to another bank or two, okay? That would usually be the case. Sweeping. That's a service offered by banks to large corporates. I want to talk to you about the liquidity coverage ratio. How many of you have heard this concept, this acronym in other classes? Liquidity coverage ratio, the LCR. Show my hands. 1, 2, 3, 4. That's a half. 5. Okay. Well, they talk a lot about this in economics, banking, and finance, because it's a big thing. So going back to this liquidity risk, okay, the risk that the bank which have lent out your deposits, now all of us want, say, our deposits back today, because contractually these are on-demand deposits, but they've lent some of them or most of them out, and they don't have the money now. Maybe if we give them enough time, it will come back, and then they'll be able to repay us, but right now they don't. So to deal with this potential problem, regulators have enacted all these laws, like the reserve requirement, but actually LCR is kind of a more binding, the binding constraint along the lines of the reserve requirement. Okay, it used to be that you just had to, I showed you maybe 10% of what you have in demand deposits from retail clients have as a deposit with the central bank. But since then, they came up with a much stricter and more elaborate and finer set of rules. They thought about this in Basel, the BIS, Bank of International Settlements, to make sure that banks have indeed enough liquidity to cover what clients may want to withdraw in the coming 30 days. Okay, so it's kind of a short-term liquidity match constraint. You can look at the PDF. I mean, I've heard so many lectures, so many discussions, so many presentations about this. Before I actually had a look at the PDF, maybe I spent a year hearing about this, learning and having to deal with this before I read the PDF. But you can just click the PDF. This is the original, and then you see the formulas, and it becomes much clearer. So basically, you have to have enough stock of another acronym called HQLA, High Quality Liquid Assets. So a deposit with the central bank definitely is the original HQLA, okay? So deposits with central banks definitely count as HQLA. Okay, that's not in this table. But also short-term government debt, and also high-rated like AAA or AA short-term corporate debt. You have to check really the definition, but central bank deposits for sure are always 100% liquid, meaning that they are available to the bank on demand. So the amount of HQLA the bank must have must equal or exceed a calculation of what is going to be, under these set of parameters, the net cash outflows out of the bank assumed over the next 30 days. Okay? The point is that it's broken down from retail deposits and wholesale funding. Wholesale funding would be also corporate clients. Okay, so you can see the parameter. This is what we discussed about banks being able to model how sticky are the deposits that they get from the clients, right? Because you have, I don't know how much in your bank account, maybe 5,000 francs, and this fluctuates up and down, but it's always above zero, right? You have this kind of stable component of your deposits, and the bank is aware of this and can just model as if this money is going to stay with the bank for a while. But the LCR forces the bank to assume that either 3, 5, or 10%, depending on further parameters, is going to be withdrawn in the next 30 days. Okay? So if the bank has 100 billion stable deposits, meets additional criteria, another 100 billion stable deposits without this additional criteria, and another 100 billion in deposits from the public which are less stable, then let's say the weighted average of this is 6 or 7% of 300 billion, then that's what, about 21 billion that the bank has to have in HQLA and cannot lend it out as mortgages or something longer dated. Okay, so this HQLA, because it's so safe and because all of the other banks have to buy this, then it's offering very low yields, often negative yields if you're talking about Switzerland. And the parameter is higher when you're talking about corporate clients. So that means that it's less profitable or even costly for the bank to let a corporate client simply park cash in an account with it, more so than a retail client. Okay? This was the whole point of this, what is LCR. Okay, this constraints, because of the parameters which are higher for corporates than they are for retail, make it more expensive or less profitable for a bank to let a corporate client over a retail client to simply park cash in an account, and an on-demand deposit. Okay? So here starts the negotiation between the bank and the corporate client. Okay? The bank is represented by more than one person, but usually there's one person in charge of this client. And the corporate client, again, is represented by more than one person, but usually there's one person, usually the chief financial officer, or one rank below him, the treasurer, that is in charge with dealing with the bank. Okay, but things can escalate all the way up to CEO if necessary. So the bank account and the bank deposit, the simple most thing, is used as a negotiation tool. Okay? I'm the bank, you're the client. You want to park some money with us because this is how you need this cash for a bit later, or because you need cash as on your ongoing, on an ongoing basis. You need cash on demand. You can't park it in any kind of time deposit or purchase any government securities or any safe securities with it. If you buy securities, that'd be great, because then it's off our balance sheet. Okay, we don't need LCR against it, we don't need any capital against it, because if there will be any losses, it's on you, because you just purchased securities. Okay, when a client purchases securities, it becomes off balance sheet to the bank. This concept of off balance sheet or on balance sheet is critical. Okay, so the bank always wants the clients to purchase things which are off balance sheet, because then that frees up the resources for the bank to do something else with the money. And here comes the negotiation. Then if you do insist that you have to have unencumbered cash, meaning cash that's available on demand for you to send it when you need it, because you need to pay this supplier or that supplier, you don't know when it's going to come, so you cannot give it any duration. You need it always on demand. And I'm the bank, and I'm like, yeah, I understand that's what you need, but what have you done for me lately for me to let you have this? You understand I have to put a high parameter on these deposits. I can only invest this in HQLA. These are not yielding very much. It's on balance sheet, so I need also capital set aside against this. This is highly unprofitable for me. I can do other things with the money. Okay, but I like you. And I'm asking you, what have you done for me lately? Do you have any mergers and acquisition or advisory business for me? Can I advise you on how to purchase your competitor, how to sell off this one subsidiary of yours? Can I advise you on that? Can I help you issue your shares in the stock market as an underwriter? You remember that's very profitable for the bank. Can I help you issue a bond in the bond market? That's also very profitable to the bank. Okay? These first things, that's what I, as a bank, need to hear from you, corporate client, to let you have an on-demand deposit with just 100 million slushing around and not have to charge you too much negative interest rates. Okay? So it's So you should ask then, why don't I just try, why all this indirect game to negotiate? Why don't I just, force you to pay whatever it costs me, including the cost of the equity that is locked up? It's because the market is such that it's hard for me to price really the true cost of the deposit at negative interest rate, because there's another bank that's willing to do that. Still, I guess I don't have the perfect explanation for this, but this is part of the market equilibrium. That the corporates are always like this, trying to get better terms from the banks for the cash, and it's always kind of a sore discussion. The basic thing of the bank account and deposits and payments, that's always kind of the beginning of all negotiations. Loans, that's really used to be in the past for maybe some periods that the banks wanted you to take a loan, but these days are completely gone, okay? The banks don't give a loan so easily at all, okay? This is become one of the most sensitive things. So firstly, it's having an account, then getting a loan, forget it, okay? You gotta go through a lot of phases to build kind of trust and collateral with each other before the bank can give any type of loan. Any questions about this? Okay, let's talk a little bit about foreign exchange. So we discussed how bank accounts in different currencies work, right? Now you know. So now we can discuss about this action of exchanging them, right? Do you remember we discussed the white stones and the black stones on the different islands, and actually they don't have to move, but just the name changes, and how banks have accounts with each other because only local banks are allowed to have an account with the central bank, and so there is required this network of accounts with each other to facilitate trading one currency for another. Okay, and this is a big market. This is probably the biggest market that trades the most amount of money daily. And there's just these two concepts of spot market and a forward market. So the spot market is, I have some Swiss francs, you have some euros, and we're exchanging them. Now I have your euros, you have my Swiss francs. That's a spot transaction. Okay? A forward transaction is when you and I anticipate that 1 year from now, I will need your euros and you will need my Swiss francs. But right now we get to keep whatever we have, and maybe we don't even have you euros and me Swiss francs. But we can enter an agreement called a forward sale and purchase agreement, where we agree today on the price and quantity at which we're going to exchange euros for Swiss francs 1 year from now. Okay? But we've locked in the rate today. And this is also a very important transaction. Okay? And then you have to understand that since we didn't exchange anything now, we just signed a little agreement called the forward sale and purchase agreement in 1 year from now, but today we didn't exchange anything. Okay, so but now if the price goes up or down of euro versus Swiss franc, then maybe I did this because I want to hedge some Swiss franc exposure that I have, and I want it hedged back to the euro. So if the price now goes up, then I will have those euros, okay, and that will offset. That's a hedging transaction. Okay, that can be a hedging transaction. So because the price is locked in, and then if 1 year from now euro has gone up, then you still need to give me those euros at the price that we've locked in today. So I'm gonna get those euros very cheap 1 year from now because I've locked them in, and since then the price of euro versus Swiss franc appreciated. Okay, so in that sense, I made a profit on the euros, and I did that because maybe this profit is not a pure profit, because maybe I have some exposure to euros somewhere else, such as to the euro Swiss franc somewhere else, and that resulted in an offsetting loss. So that profit is just to cover my losses. So it's a hedging transaction. So this is it's the hedging tool. Okay, forward sale. This is used to hedge currency risk. Okay, so let's do an example. Let's say I think in dollars. Okay, all my investors are US based. Okay, and I manage their capital. So I want that, but I see good investment opportunities in Europe, in loans, various types of loans. Okay, so I exchange the dollars into euros, and then I lend out the euros at a high interest rate. It's quite profitable, and this is my mandate. This is what I do for my shareholders. But wait, if I just do it like this, then what happens if euro goes down versus the dollar? Then maybe I made 10-12% interest on the euros on these loans, which are very good, but I lost 20% on the exchange rate. And that's not a risk that I wanted to take. Okay, so the way to hedge that is that the day I convert the dollars into euros in the spot market, so I could lend them out as a loan, same day I convert them, I also enter a forward sale of those euros into dollars for, let's say, 1 year from now. And then I'm hedged. Okay, maybe you need to do a T-bill for this, a T-account for this. I don't know if the exam would be the perfect place for you to experiment and practice this T-account, but check it out. What's a forward sale? What I've just described is how you hedge currency risk. Okay, so I've hedged my euro-dollar risk back. I've hedged my euro risk in these loans back to the dollar. Okay, so that's done with forward sale. So this is a very popular. Okay, so there's a very big, legitimate, non-speculative reason to enter these transactions, forward sales. Okay, so that's trading, and you guys know mostly stocks because you know the charts, and you know those stocks trade on stock exchanges. Okay, and that's true, but what about currencies? Euro, dollar, talking about spot, also forwards. Where do they trade primarily? Any guess? So just think back to where these things are booked. Okay, so all the dollars are with the Federal Reserve. Only US banks are allowed to have an account with the Federal Reserve. Any European or non-US bank that wants to offer its clients dollar accounts must have an account with a US bank, which in turn has an account with the Federal Reserve. Same thing with the ECB for euros, and same thing with Swiss francs, with Swiss banks for the SNB. So you can see the banks are at the core of currencies, okay? Because that's where they are booked. That's where they're kept. That's where the accounting ledger resides. And so it's only natural that trading in currencies takes place intra-bank. So it's literally all the banks in the world trade with all the banks in the world. And that's where trading takes place in currencies. That's how trading takes place. It's not in any one centralized exchange. It's intra-bank. So all the banks in the world, there's thousands of banks all over the world, they trade with each other. And the big banks, there's a natural monopoly in trading. Of course, everyone wants to trade where everyone else is trading, because that's where you get better prices for whatever it is you're trying to buy or sell. So trading is a natural monopoly, and then it tends to concentrate in places where it's already concentrated, and then the big banks, they aggregate most of the trading in currencies. Okay, I hope this is clear. And this thing called post-trade clearing and settlement. So trading is easy, okay? When we shook hands to exchange spot, your euros for my Swiss francs, this we've done on some intrabank trading. Let's say you're a bank in Germany and I'm a bank in Switzerland, and we have a system, I'm pretty sure it's the Swift messaging system, but I'm not sure about that, okay? So I'm not sure which exact system they use for this trading. I should check it out. But we've agreed on this trade, and this is done by a communication system, okay? When first we agree on a price and on the quantity, but then we actually have to deliver. You have to send over the euros and I have to send over the Swiss francs. And so after we've done that, that's called settlement. So you have already my Swiss francs and I have your euros. That's already settled. But in the meantime, there can be any number of clearing mechanisms to make sure that after we've agreed, you don't just go home and not do your part, or I go home and not do my part. Okay, that's the risk of non-payment, called settlement risk, or not. Okay, non-payment and non-settlement. That we've agreed on a trade. You have to understand, when I sold you the Swiss francs and I agreed to take the euros, then I have a need for those euros, and maybe I've already contracted with someone to give the euros tomorrow because I was expecting you to bring them over, to send them over, and it will be in my account tomorrow. And I've already sold them forward today, and tomorrow they will be gone, and you didn't deliver. Now I'm in trouble. Okay, this is not something that is desirable for me, and this is not something desirable for anyone that's actually trading. And then they came up with a central counterparty. And you can imagine that if all over the world you have different banks, and the banks have clients, corporate clients and retail clients, and those clients are also the banks themselves, they need to exchange currencies as per the demands of the clients or as per the demand of the banks. There is an efficiency here if we made one trusted counterparty, and we would all trade with this trusted counterparty instead of with each other. Okay? And then I would send, let's say you're the trusted counterparty, I'd send money to you, I'd send my Swiss francs to you, you'd send the euros to him, and then when you have both of them, then you'd send them, you send me his euros and him my Swiss francs. And let's say we've made a lot of trades, everyone made a lot of trades with each other, there's huge netting opportunities. Maybe I don't need to send the whole amount to him because I've made also a trade with someone else to buy or sell. Okay, I don't have exactly the example, but there's huge netting opportunities. Maybe I don't need to move the whole amount because, okay, he owes me, who owes it? Okay, there's a lot of opportunities to net amounts, and then I only need to send the net amount. But only you can figure it out because you're connected to all the banks. Okay, and there is such an institution. Is there a question? Yeah.
So how does this institution make money when
I take a small fee for every clearing transaction. For every time that he sends the central counterparty his euros and I the Swiss francs, he takes a small fee from me and a small fee from him.
Okay, so they have to pay to trade with this?
Yeah, I mean, that's not a problem for him because I sent quite a large amount of euros and he sent quite a large amount of euros and I sent quite a large amount of Swiss francs. And just before he sends him my Swiss francs, sends me his euros, he keeps just his little fee. So he has our money, so it's not a big deal for him that we don't pay. And this thing is quite an unknown. And this link works. And there's a cool video, I found this yesterday. Tsunase. Pretty cool video. This is a very unknown institution, even that it's used.
Markets don't stand still. The FX market is a dynamic global marketplace in which trillions of dollars of transactions are made and settled every day. And every day, the thousands of parties and players who trade within the FX sector are subject to significant risk, settlement risk. We at CLS mitigate that risk. Launched in 2002, we transformed the market with our innovative approach to settlement risk mitigation and multilateral netting. Our specialists have worked to reduce systemic risk ever since, creating operational efficiencies and significant cost savings for our clients. We do this through the operation of the largest multi-currency cash settlement service in the world, mitigating risk for the world's most important financial institutions, our members and their clients, funds, banks and multinational corporations. On their behalf, using our unique payment versus payment system, we are settling payment instructions for currency trades in 18 currencies for counterparties across the globe, simultaneously in real time and with finality. Every day we handle around 1 million payment instructions and settle some $5 trillion of transactions. Our clients benefit from multilateral netting, which calculates the net funding required to settle payment instructions, meaning each member only needs to transfer the net amount of its combined payment obligations in each currency. This considerably reduces the cash required for each member to settle its payment instructions in a given day, free up to 96% of cash flow for other business growth opportunities, empowering our clients' success. Markets don't stand still. We don't either. CLS, Trusted Market Solutions.
Enjoyed that. So I was quite surprised when I find out about this institution, how little known this is in the public. That this is a huge institution, it trades maybe $5 trillion worth of currencies a day. Of course, this is intra-bank, and this is not something the public hears about, and it works seamlessly, so no major headlines to say how things are going badly, because it just works seamlessly, and that's how it is. When things work really well, then you don't hear about them. Again, this is a natural monopoly. You understand here that you need one, and once you have this one, there's not even any reason ever to try to compete with it if it's working properly. So there's no abuse of this monopoly power. So I guess the governance of the management of this institution is working just fine. I never heard any complaints about it. But this is a huge natural monopoly. And again, what I've been trying to show you, that everywhere in finance you have these natural monopolies. It's like a natural fountain of capital, of money, okay, that you can make a lot of fees, and then that's where you want to be. You want to sit on a very nice little fountain of yours and just collect rents from people, from passerbyers, because they have to go through you. Okay, the banks allow corporate clients direct access to CLS system via their account. So the large banks a large bank would have an account with CLS, and therefore it can settle currency trades, faster, cheaper, and only using the net amount. So the netting benefits, that's one of the biggest benefits. And then instead of doing just bilateral, yeah.
Yeah, a question regarding CLS. Who owns and runs?
I think it's about a group of 20 or 30 banks.
Okay, so that's maybe why it's not abusing its power.
Right.
Okay.
Yeah. So it was set up by a group of 20 or 30 banks. It's public information. You can just click it. So that's probably why. So at some point the bank said, "Whoa, we are trading with each other bilaterally. Wouldn't it be wiser if we all chipped in together and set up this institution that does multilateral settlement for us in currencies?" And that's what they did, and this is the result. Okay, and then if you're a corporate client and you want access to this kind of real-time settlement and only allowing these netting opportunities, then you can go via your bank and your bank would take a cash back. So you're the central counterparty, you asked me about fees, then if I'm the bank and I'm working flow, this is an expression, I'm working the flow of one of my clients, so that means these Swiss francs that I'm sending him for his euros is not me, the bank's needs. It's one of my client's needs. I'm doing this on behalf of the client. So of course, you would take a fee from him and a fee from me, but I would let you know that this is not my flow, this is his flow, my client's flow, and then you would cash it back to me. Okay, so some of the fees that you took off my client, you would cash back to me. Okay? So this is another source of income for the banks from their corporate clients. And this is a bit of a sidetrack. There has been a case in court, in Supreme Court in 2014 in the United States called Alice versus CLS. Alice is an Australian patent troll. You know what's a patent troll? It's an expression that,
Yeah, someone who tried to enforce like very vague patents on everyone
Right.
and everything.
exactly. So frivolous lawsuits for the infringement of very generalized patents that can mean anything. And this guy changed the world, this mini world of patents and finance for all of us, because he pushed it too far. You know, it's like when someone breaks the law and then everyone was running through this loophole and just this one guy ruined it for everyone. And that's kind of what happened. But it's a good thing that this guy, Alice, got a patent for basically describing this third-party settlement or multilateral settlement as it's firstly performed by a computer. Okay? So he got the patent because he described something that was deemed in court as a common economic practice long prevalent in our system of commerce, which is third-party clearing and netting of the needs to settle. So this has been described already in a book, and this was in court, in the case court, a Japanese book or more than 100 years old, that I give you the money, he gives you the money, and then when you have both our monies and everything matches up, then you give me his money. Okay, that's third-party clearing. So this has been described already in a book of more than 100 years old. But this guy got a patent for describing this, performed by what was deemed in court generic computer function. Okay, just a regular computer, not like some supercomputer, not anything that enhances the ability of the computer to perform calculations. So let me just finish this, and then we can have maybe a bit of a longer break. So it was possible up until 2014 to get a patent for any economic practice, even if it's a common economic practice, if performed by a computer function. And this did result, as unreasonable as it sounds, it was really unreasonable, and there was hundreds and thousands of patents describing everyday kind of hedging activity, everyday kind of activities performed by a computer, and there's nothing so special about this computer, it's just generic computer function of adding and subtracting, and people got a patent for this. And Alice versus CLS is a patent troll that tried to sue CLS, which is backed by all the world's banks, and trades maybe 5 trillion a day, and he lost. And ever since then, it's become impossible to get a patent for something that is a common economic practice performed by generic computer function. But the window is still open. There is still the possibility to get a patent for something which is novel, non-obvious, novel means new, non-obvious, and useful, even if it's implemented with generic computer function. Okay, so I got a patent, it's going to be issued any week now, actually, after Alice versus CLS, and it was a lot harder to get this patent passed because of Alice, but still I got it very recently, because it was deemed something that's novel, non-obvious, and useful, and these are the legal definitions of what is patentable in the US, and elsewhere the law is very similar. Even that it's implemented with generic computer functions. So my invention is in the field of finance, and it's executed with a computer. There's nothing so genius about this computer. It's just adding and subtracting while sending orders, just like any computer. It's a generic computer, but it's executing a process which is novel, non-obvious, and useful. So this you can still get a patent, but it's become a lot harder. The bar to get a patent for anything in finance has become a lot harder after 2014, Alice versus CLS. CLS relates to our course. It's a bit of a detour. Now we can take our break. Alice versus CLS patent law. It's a bit of a sidestep. It's not strictly related. It's related, of course, you can see, but it's not going to appear on your exam. Any questions about foreign exchange? All right.
I don't know.
Yeah, sure.
CLS, is it open 24/7?
Good question. And the answer must be no. Because if you try to convert currency on Sunday,
Yeah.
you can't.
Yeah, but you can't trade like
you
currencies on the weekends as well, right?
Depends where. Depends with which bank.
Okay.
Not really as a market standard, no. You cannot move money on the weekend. If you send dollars from one account to another account or any currency, it doesn't move on the weekends. It can be that a bank lets you put in the order. Let's say you're a client of a bank and you want to exchange Swiss francs for euros. Maybe the bank is willing to let you exchange it at some exchange rate that already kind of incorporates some profit for it and lets you lock in the rate. But usually they don't even let you lock in the rate over the weekend because the markets, for them to hedge it, are not open. So they don't know what's the rate. So on Sundays it's really closed. And also you cannot move money on the weekends, not on Saturday and not on Sunday. Which is a shame, right? That's why they came up with cryptocurrencies. 24/7, nobody can block it, nobody can do anything for you, nobody can stop it, nobody can, there's no junior lady or boy to tell you what is this transaction. Yell at you and say it's not allowed. But that's life with regular currency transfers. corporate loans. So now we're getting to the heart of banking. That is what banks do with our deposits and the additional funds that they borrow from the public via issuance of bonds. I've shown you a balance sheet of a representative large international bank here in Switzerland. They have about 900 billion in financing sources available for them. Okay, well, maybe it's about 400 billion deposits, maybe another 400 billion in borrowing instruments, other liabilities that they've issued, like bonds and short-term notes. And then the rest is more like net replacement values of derivatives. Let's not get into that. But then all these deposits and cash proceeds from issuance of bonds, that is fair game. That's sources of financing for the banks to lend out. And then what do they primarily lend out? Mortgages, loans against securities. So I don't know if you have brokerage accounts, but if you do and you love Tesla, maybe you love Tesla stock so much that you want to buy it on loan with leverage, meaning you buy more Tesla than you have cash in your account, then you go into minus overdraft in your brokerage account, and then your broker starts charging you for that. That's called a margin loan. That's also quite a large business for the banks. So it's number mortgages, corporate loans, and margin loans. And derivatives, net replacement values, forget about this for now. These are the three primary loan assets for the banks: mortgages, corporate loans, and margin loans. Margin loans are by far the safest. Okay, and we'll get to margin loans. Let's not get ahead of ourselves. Okay, so overdraft. Yeah, if you're a company, you have a bank account, you can go into minus in your on-demand deposit, and then you start incurring interest costs. The bank that's profitable for the bank. The bank prices this correctly. Also intraday, you can be short cash intraday, and you'll be charged for half a day or a full day. I'm not sure. They're cheeky, so if you're short even just for a part of a day, they're not going to charge you pro rata for that 1 hour from out of 24. They're going to charge you for a whole day. And of course, the more retail you are, the more, let's say, insensitive they are to these little things. But the bigger you are, the more you can negotiate with them. Okay? The richer you are, the more you're sophisticated about these things, because you hire people like, then they know how to count every cent. Okay? And then it becomes just a kind of a rational business decision to put up all the banks against each other and negotiate on behalf of this big client, because this is called, that's what a family officer would do. So this is another concept that they invented. Means that it's a person, that his job is to take care of the money of this family or a few families. Okay, and some of them are quite professional, some of them less professional, more on the relationship management side. But some of them are real professionals, and then all they do is just the professional part and try to maximize the capital. And that's actually something that's growing, and has been growing the last I don't know how many years. But we're corporate loans. So here's different types of loans. It's not an exclusive list, but these are the primary types of loans. So just unsecured loans to a company. And again, this concept of secured and unsecured is just a language convention, okay? What is secured and what is unsecured. What I know is the market convention for the language of it is that if I'm lending you money to build a building, and then the building itself serves as collateral, you may be a company and you have other assets, but I'm taking that building in particular, firstly, as collateral, then it's called a secured loan, because it's secured by that building. If I'm lending you the money against your entire balance sheet, maybe there are other lenders who have lent against that building, and then I'm lending at whatever is left, or maybe there's nobody else who lent you money, and then it's against your entire balance sheet, which includes the building, but still it would be called unsecured, because it's against your entire balance sheet. But then again, it depends what we write in the loan agreement. If I am the first person to lend you money, and you have this building, I may write in the loan agreement that you may not take any other mortgage, you may not take any other loan which would have priority over my loan. Okay, and then I'm always going to be the first, and then I'm not sure how to call this, if it's secured or unsecured. You have to dig deep into the details and find out again exactly where I rank relative to other lenders, and that's extremely important. Where I rank in priority relative to other lenders, and what really from the company is left as collateral for me. Because maybe you have 5 buildings and no other assets, and there's a mortgage against each of these assets for 100% of the value of these houses, and then you have no equity left other than that, and then I lend you some more money against that, but then there's no equity in it. Okay? But it's actually a common practice if we're talking unsecured loans for land development. So it's quite common that, let's say, if you're a real estate developer and you're building 3 buildings, you would take a regular mortgage against each one of these buildings, and then the mortgage lenders against each of these buildings would have priority with respect to these buildings. But they would only lend you maybe 80% loan to value or 70% loan to value, and then you would need to come up with 30% own equity or money from somewhere else to finance the rest of it, because it costs $300 to build them, 100 each, and you got 70 from each of the lenders against these houses. Now you need to finance another 90, right? That's 30% from 300. And where are you gonna come up with these 90? So maybe you're gonna come to me, and I would be willing to take a second lien against all of these 3 properties and give you not the 90 but 45. So you bring 45 from home. Each of the lenders will give you 70 against each of these buildings, and they have a first mortgage, first priority against these buildings. And then I would come as a second lender and lend you against the residual value of each of these 3 buildings, another 45. And together you'd have your 300. Okay? So this also happens. This happens in real estate a lot. And then maybe that 45 equity, maybe you'd issue these as shares in the stock market. Can be. And then you're just like an employee for this company. Maybe you just see it. So the big real estate investment trust, what they call, they have an acronym for this, REIT, the United States, but you have them everywhere. These are huge companies that they are the equity shares. That 45 is not owned by any one person that's actually building or doing anything. They are owned by the public, by the stock market. Okay? But these companies, they are leveraged because they take additional loans against the buildings. Against every project, they take also bank financing. Okay? So financing is a very kind of flexible game. Okay, you get the money where you can, and you invest it where you get higher returns. And if you're good at it, there's enough money to be made from the dawn of history. It's been profitable. Okay? So which one is better? Why is it that the banks give such low rates Because it has to do with the risk, it has to do with the supply of capital, it has to do with institutions having some sort of rigidity. Okay, banks and other big institutions, they cannot do what an individual can do. An individual can borrow from here and do whatever he wants, but banks, they can only do things according to the process that they're already doing. They cannot deviate from script. Okay, unsecured loans means that it's a loan against the entire balance sheet of the company, not against any one particular asset. And all these others, they are actually secured types of loans. And then we're gonna go one after the other, and I think you're gonna like it because it's gonna put more color into this business activity called finance. So one is called factor finance, or invoice financing. Anyone ever heard of this? In German it's called factoring. Anyone ever heard of this? 1, 2, 3. Invoice financing is as follows. Say you are a small company, and you're a big company, okay? And you just supplied a good or a service to this big company. The market structure would be that you provide the good or service, and then you issue the invoice, and then the big company pays you after 30 days, or 60 days, or 90 days. It takes some time, okay? Until the finance department gets the invoice, until they sign it, they have the process. It's a big company, okay? You wanted to sell to them, right? Because you're a small company, you need the business. They're a big company, they don't do things so quickly. It takes 30, 60, 90, sometimes 180 days. And of course, because this has become the market structure, there would be people there who would maximize the number of days without kind of bankrupting you or without kind of breaking the rules, without breaking the rules of the game. But they would maximize that. You can realize that the person that is one under the CFO, the treasurer, the one that has to deal with the banks, and the banks are like this to him about the cash, then he would say, okay, well, you're gonna have to wait a few more days until I get the other cash, okay? So the bigger ones have more power, and then the smaller players are choked for cash, because you're basically financing a bigger company. So you're supplying, but you've incurred the costs to buy, the cost of goods sold, but now they're only gonna pay you, and here comes a bank or a private lender, and I would buy the invoice from you, okay? He owes you 100, here's 95, and now he owes me the 100, okay? And then maybe he pays me after 2 months, and I've made 5% in 2 months, okay? So this is called invoice financing, or receivables finance, yeah.
What if they don't pay the invoice?
So here comes into play all the legal work. Okay, when I purchase this invoice from you, I don't just give you money. I give you money and we sign an agreement. And in this agreement there could be several mechanisms of control and security for me. So firstly, I'm kind of relying on you, the seller, to be honest and not issue a fraudulent, okay, if he's produced a fraudulent invoice, then this is the realm of criminal offense. This is not just corporate law or contract law, this is already criminal offense. So if that would be already a big problem. And that is a problem still. And then secondly, I also need to rely on you to sell me something good, and then I would often write down that in case of default, then you pledge to purchase back the invoice. Okay, we can write this. You're coming to me, right? You want cash now, right? Because you have an invoice. You need this cash to go to the next business. And if you really want it, then in the loan agreement, if he doesn't pay, then you need to buy it back. That's one mechanism. Okay, a second mechanism. Okay, maybe that's the second mechanism. The first mechanism is that this is a company that owes money to him. When I purchase this from him, they owe it to me. And if they don't pay me, then I will take them to court for not paying an invoice. And in addition to taking them to court and potentially pushing them into bankruptcy, I can also push him into bankruptcy because he signed that that's a company. And in addition to that, I can take also a personal guarantee from the shareholder or from the director. Okay? I take a corporate so I'm lending unsecured to the big company, and that's the beauty of it because I finance a small company with a high interest rate, but now I have a claim against the big company that has a higher credit quality. They can probably borrow at 5-6% from the banks, but I bought from him a claim against a big company yielding maybe 12 or 15%. Okay, so it's still it's a lucrative market. It's still a lucrative kind of business activity. It's been around since forever. It's nothing new. It's been around since forever. So these are the two main. Firstly, it's a legal claim against the big company, and if they don't pay, then it's just like not paying any other of their suppliers or not paying a coupon on their bond. They could be pushed into bankruptcy. If I made the small company give a corporate guarantee, a buyback guarantee, then I could also take them to court. If they don't, then I'll be taking both of them to court. And if I got also a personal guarantee, then I'll take this company, the small company, and the director of the small company. And these are the three mechanisms. And then there's another mechanism of control that it may be that I, in this agreement, also write that there could be two ways. Either he pays him, and then he pays me, or even better for me, that he pays me directly. Okay, so I can write down that the invoice, it's not only that the big company still thinks that they owe the money to the small company. This would be non-notified. He can sell this to me, but the big company still thinks that they owe the money to the small company, not to the funder. And this would be a bit riskier for me, because when the money goes to him, maybe now he gets into trouble, can't pay. And even safer would be to notify him that the ownership of the claim against him has now changed from the small company to the bank, and now he owes money to the bank directly. Okay? And if we don't want to do that because it's sensitive, small company doesn't want to let the big company know that they've sold the invoice, and I can say, okay, well, it's going to be a bit higher interest rate, and also I want signature right in your bank account. So any money out from your account, I need to sign it. Okay? This is the mechanisms of control. Yeah.
So normally in the market, when you do this type of thing, when you sell an invoice,
Yeah.
and for example the company that owes the money,
Yeah, the big company.
yeah, the big company that you bought,
Yeah.
you bought the invoice, if they are delayed in payments, or is it then your responsibility to actually notify them, hey, you need to pay,
Yeah.
or will it still be with the...
No, it will be me. I'll push them. I'll take them to court.
Okay.
Because I own the debt now.
But that's only in the case that it has been notified.
Even if it hasn't been notified, I still own the debt.
Also, when it's not notified, you can still push it.
Yeah, yeah. You just don't know about it. It's gonna be a surprise.
So,
Any other question? Yeah.
How much time does a business have to actually pay an invoice? Is there
Now, the market is such globally. It's either 30, 60, 90, max 180 days. 180 days is not like India or I don't know. It's not. But in Switzerland is like 30, 60 days. Okay. The more kind of westernized the country is, the better are the payment terms. Less of a mess the whole thing is. You have to understand that people deal with each other. Everyone has attention deficit disorder. Nobody is organized, and things take longer than they are. That's why in finance, you have to be a gentle nagger. People owe you money. People need to do things for you. It's not in your control, it's in their control. You have to gently remind them to do it all the time. So a gentle nag over the evening. things. But either 30, 60, 90 days is still kind of westernized. 180 days is more, kind of more third world. Yep. Commercial mortgages. So again, if there's like a big shopping mall, then the land and the building serves as collateral. It's just like any real estate, only that it's used for commercial purposes, not residential purposes. Land development, again, is the real estate development, but just at an earlier stage. For real estate, there's unique points where financing is required. So first, when buyer buys the land, he needs financing, okay? And there's a valuation for the land, and against this value, a bank or a funder would lend maybe 70 or 80% loan to value. And then when is this value going to increase? The next time it's going to increase is when they have put in a plan to build something. This has to be approved by the local Gemeinde. Okay? The local municipality needs to approve the plan to build residential, commercial, old people's home, whatever it is they're building. It needs to be approved, and there's a process for this. For just to get this approved requires expertise and patience and know-how how to push this through. And once that's done, the value increases that day. Okay, when it's approved, the value increases from a land without a plan to a land with an approved plan. And then with this plan, you can interpolate how much it will cost to build and how much it will sell for based on market prices. And then you can calculate the value to today, which is higher than if it's just land. And then, so for this stage, it's called the bridge loan. Is you're lending just from the purchase until a plan is in place. And after a plan is in place, more money is required to actually build it. And that's called development loan. All right? And then either it's the same lender or someone else is lending the money for this phase. Okay, so therefore usually the bridge is the safest part, because if the whole thing is a bit overvalued, and progressively so because you have to roll up the interest, then it's only going to be found out towards the end that more money is owed on this property to different lenders than it can actually sell for in the market. It's only going to be found out later. So if you're lending earlier on, then you can still kick the can down the road and you have a few exit opportunities. Okay? But things usually get hairy during the development. So at some stage during the development, if there's delays and additional costs, unexpected, especially delays lead to unexpected interest costs, and then more money may be owed on the property because this eats into the collateral, to the equity, right? This eats into the equity. If it was 70% loan to value, not 30% equity, but now the value hasn't increased because they haven't been developing, it's not yet ready, then the interest still keeps accruing, and then it's not 30% equity, it's only 20% equity, only 10% equity, then wow, this whole thing is worth less than what we owe on this, so we're not doing any more work. Here you go, take it, sell it, whatever you can get. So it becomes riskier towards the end, because towards the end it's really found out if things have been executed correctly or not. Okay, so that's kind of the natural financing cycle of real estate. So there's the bridge part, and you put a plan, and that's really quite the safest, I'd say. But of course, if so many people think that this is the safest, then it's going to be overly supplied and interest rates are going to come down. Okay, so it can be safer, but whether it's lower interest rate, I say no, because I see the same interest rate for the development part as they are for the bridge part. So in my subjective opinion, the risk is lower for the bridge part than for the development part, but I see same interest rate, so I prefer the bridge part. But could be wrong. Okay, so this is not a fact, this is an opinion. Agricultural loans, yeah, you need to finance big farms, small farms, corn, wheat, cattle, okay, chickens. These are things that people consume. These are massive crops, and they need financing. And it can be that the bank is providing the loan and takes the land as collateral or takes the livestock as collateral. Okay? And there's quite interesting stuff that can go there. Trade finance, that's also big business for the banks and for the commodity trading companies. Yeah, all these goods, copper, aluminum, oil, they're produced in one place and consumed in another place, and they need to be shipped. So there's the part of the shipping, okay. Also, the ships themselves need financing, okay. If I'm in the business of running ships because I take fees from commodity producers, and commodity producers pay me a fee to send their product to wherever, and I own the ships, I also need a loan to finance the construction and ownership of the ships, okay? So in this case, the loan from the bank or from whatever finance company would be collateralized by the ship itself, but also the delivery of the commodity would be financed. So usually the market is such that the seller only pays when the good is delivered at its port. So if I'm an airline company, and I just bought a bunch of oil from a refiner, the refiner already refined it to jet fuel from crude. So it's jet fuel already, I buy it from the refiner is over there, and I'm over here. Then I will sign the agreement with him that he's gonna send so and so amount of jet fuel, but I only need to pay when it reaches. Okay, so there's financing is needed also at this stage. Everywhere, finance is always about timing, okay? Wherever there is a timing difference between something and something, both these somethings cost money, then there's a bank or a financing company that comes into play to just provide the capital so things can work, and then the producer and the consumer can just do what they do, produce and consume, and we're just supplying the capital. But of course there must be a lot of mechanisms of control for it to work for us, because if it's not working for us, the capital providers, then we're not giving up the capital, and then you guys cannot do whatever you are trying to do. That's how it works. Corporate airplane financing, okay, it's not so big like people think, but it's a niche kind of market. You take the airplane as collateral. So wherever there's a very clear registration and control, like over ships and even more so over airplanes, you have to understand that air traffic control is highly controlled and regulated. You cannot take off from anywhere and land anywhere without this being registered and without permission. Okay? I was an air traffic controller in the Israeli Air Force for a brief period of time, but that's how it works. You cannot take off or land anywhere without permission. Okay? And if there is, and every plane is registered in a central registry, okay, a national central registry, and they have exchange of information between the countries. So it's quite straightforward to control the airplanes. So if I'm a lender and I lend you money to buy this airplane, then no, you cannot just simply take off and never come back, because it'll be very highly likely that you'll get caught and you'll be stopped, because you cannot just fly wherever you are. It's Flying is very highly regulated activity. And that's how it works. But of course it requires expertise. I wouldn't know how to really do it. But the lenders, they have people that they have experience at the desk level, okay? There's accumulated experience at the desk level. They have the relationships to the air traffic controllers, the central control units in every nationality where they're lending, and they know the processes and they know how to make sure that there is what's called a chattels mortgage. In the UK it's called chattels mortgage. It's a mortgage just like against a house, whether it's against a boat or against an airplane. It's registered that this airplane is encumbered with a loan. And as part of this loan agreement, it may be that you may not fly this airplane anywhere or outside the country. Usually, I would specify you may not fly this airplane outside of the country before you repay the loan. Because if you fly it out of the country, then it becomes a little harder for me to enforce. But if it's still within the country, it's much easier for me to enforce. So that would be kind of a standard control mechanism. And yeah, just like you asked, it's all about the control mechanism to make sure that they repay. Finance is all about control. Because you're giving money to people or taking money from people, it's all about the control, how you get it back. If you can't get it back, then you don't give it out to begin with. And then the whole thing doesn't work. But if it's for a legitimate person, then they will come up with control mechanisms, because if I'm an honest borrower and it's profitable for me to borrow because then I can do this business activity, then I will be able to give you the control mechanisms you need to lend me money. Oil and gas needs to be financed. So the exploration part needs to be financed. Exploration part is usually financed with equity. Wherever it's kind of a 0-1 situation, biotech, startups, oil exploration is usually financed with equity. So some shares in this venture is sold to the public or to a group of large investors, institutional investors, or family offices, and they would participate in the success or failure of this alongside with the entrepreneur. They would get shares. Whenever things become more tangible, like if you've already found oil and you're just now going to develop this, then you can get debt financing from a bank, because then you can use the land and also the oil inside the land as collateral against the loan. Okay? So it's kind of the market. You remember we were talking about debt, and I was making you think about when do you have this schedule of amortization or that schedule of amortization? And the answer was, well, it depends on how revenues will be generated from this project. You get to match the revenues on the asset side generated from this business activity with the principal and interest repayment, because you want to match them because it's just more efficient this way. So it's the same thing of the decision when to finance with equity and when to finance with debt. Okay, so if you think about it, the more it's kind of a venture capital type thing where it's a 0-1, then equity financing is more suitable. When things become more stable, then debt financing becomes more suitable. Okay, and here there's an interesting little riddle for you. So, if I'm a bank and I'm lending you in order to develop this field, and we know that the value of the oil inside the ground is worth 100, and I'm lending you 80 to build whatever you need to build around it to be able to pump it out the ground. Then if the price of oil goes down, then this oil is not going to be worth 100 anymore. Maybe it's only worth 80, but I've lent you 80. So in that case, maybe I sell it to someone else and I get my 80 back, and you've lost the 20, right? But what if oil goes down even further to 60? then you lose your 20, and also I lose 20 out of the 80 loan that I gave you. Because I was only able to sell it now to someone else for 60 because the price of oil went down from 100 to 60. So the payoff for me, forget, let's say the interest rate is 0 because the interest rate is not really the point here, is like what? If oil, as long as oil is above 80, I'm making 0. Let's say 0 is a good interest rate for me. And if it goes below, then I'm losing linearly. So this payoff looks like which financial instrument?
An option maybe?
Yeah, which one? For me. I'm long put.
Okay.
I'm long put the oil. Alright? Sorry, I'm short put. So this is $100 for the oil, and then my payoff is 0 until this is 100. That's the price of oil, and this is the payoff. This is 0 for me, and this is 80, and then it goes down like this, right? But I'm a bank. I don't like to take risks on oil. I just want to make the interest rate. Okay, so I would hedge this by buying put options in the options market, and then someone else who has a need, probably a consumer of oil, would buy them, would sell them to me. Yeah. So on the bank, I would hedge it by buying a put, because my payoff from this, if oil goes down, if oil goes down, then all of these companies for oil development that I've lent money to, I thought this was a good interest rate, but I forgot to hedge. And then all of them go bankrupt at the same time. Okay? I don't want that, because I just want the interest rate, because I have capital, and then on capital I can just make interest rate, and that's my business. I want to keep it safe, diversified. I don't want to gamble on oil. Then what I would do is I would buy some put options to hedge against this risk. So as oil goes down, and these loans are coming closer and closer to default and potentially producing a loss, and I'm making money on the put option that I've bought. And then I'm hedged. Okay? Any question about this? And then the cost of the option, okay, I'm paying a cost, because if the price of oil just stays the same, then the option will decay and its value would go down to 0. I've paid something for it, but the value would decay and go to 0. And that's a cost for me, the lender. That would be priced in the interest that I'm charging you. Okay? Or we can say that, or in our loan agreement, I would force you to hedge it yourself. So I tell you, you want a loan from me to develop this, you have to forward sell, and there's a futures market for this, your oil production. And then that guarantees that if oil goes down, then maybe what you're going to produce is not going to be valued so high, so just that wouldn't be enough to repay my loan. But because you've already sold short your future production, then you're going to make a profit on this short future positions, which will offset the loss from the actual production, and that guarantees that you will always have enough money to pay me back. Then that would be a futures short. Okay, the loan is a put option, and yours is a future. And that's from that arises from this, from the nature of the loan. Okay, that up until you can pay, then I don't take any losses, but if you can't pay, then only I start taking losses. And that recurs everywhere. That's why I'm teaching you this example, because this part It's the same thing for a building, the same thing for everything. There's a point where maybe I financed you for a building, for you to buy and build a building, then if the price of that building goes down, I don't really care up to a certain point when I start caring. So it's the same thing with oil. If the oil goes down, I don't really care, it's your problem up until a certain point where I start taking care of. So for me, it's like a put option, which I've sold short, and then if for you, it's a somewhat different payoff. So either I force you to hedge it in the forward or futures market, or I hedge it myself in the options market. Any questions about this? But just also the pipes and transportation needs to be financed. Okay, if you're building a huge pipeline, that needs to be financed in one way or another, usually with long-term debt. Because just remember, pipes, like it's a huge investment up front, and then it pays pretty much as kind of predictable amount forever. So maybe a 20-year loan could be the right tool for financing here, even more so than equity. Okay, transportation, refineries. Also, refineries need financing. Okay, they buy crude oil, they refine it. It takes electricity and energy and time, and then they sell it as petrol for cars, gasoline, diesel, jet fuel. And also the oil field services, the drilling, the rigs. Okay? The rigs need to be financed by someone too. Okay, we didn't really finish all of it, but you can read the rest of it. Alright, yeah, have a nice week, guys.